All right, let's talk about something that pretty much every modern company deals with if they want to get the best people on board, paying them with stock. Today, we're going to break down IFRS 2 and figure out the true price of making a promise in shares.
So you'd think this would be a simple question, right? But the answer, well, it's way more complicated than you might think. Giving an employee stock options isn't like cutting a paycheck for a set amount. It's a promise, and the value of that promise can swing wildly over time. So how does a company actually put a number on that for its books? And that's where IFRS 2 steps in. You can basically think of it as the official international rule book for this stuff. It was created to make sure that when companies use their own stock as currency, that cost gets recorded properly. It's all about making things fair and transparent so investors can see what's really going on. Okay, so IFRS 2 gives us two main ways to handle this, two paths to take. Let's start with the first one, which is by far the most common, the equity settled award. I like to call this one the fixed promise. Let's use an analogy to make this crystal clear. Imagine a company pays you with a literal gold coin. The day they hand it to you, what accountants call the grant date, they figure out its value. And that's it. That value is locked in. It doesn't matter if the price of gold goes to the moon tomorrow, the company's cost for that coin is fixed. So here's the absolute key takeaway. The fair value is calculated one time, right at the beginning. That cost then gets spread out as an expense over the period the employee has to work to actually earn those shares. That's the vesting period. And that last point, no future surprises, man, for a company's finance team, that is pure gold. It means the cost is predictable, they know what they're in for, and it won't suddenly blow up their earnings report. All right, so that was path one. Now let's flip the coin and look at path two. This is the cash settled award, or as I call it, the floating promise. And you can probably guess from the name that things are about to get a little less predictable. So sticking with our gold coin analogy, this is totally different. Here, the company doesn't give you the coin itself. Nope. They promise to give you the cash value of that coin at some point in the future. And you see the problem, right? If the price of gold doubles, the amount of cash they owe you doubles right along with it. The promise is literally floating on the market. And wow, does this change things? Instead of a one-and-done valuation, the company has to recalculate what it owes at every single reporting period until it's paid. This creates a liability on their books, and every little change hits their income statement. Now, you're probably thinking, why on earth would anyone choose this roller coaster? Well, sometimes it's a clever way to give employees a taste of ownership without actually giving away stock and diluting the existing owners. Let's make this real with a quick example from our source material. So, a company grants these awards that vest over 3 years. Look what happens. As the share price goes up, so does the expense. Year 1, it's about $8,000, but in year 2, they have to remeasure, and boom, the expense for that year jumps to over $13,000. By year 3, it's over $14,000. You can see right there how this floating value can cause some serious turbulence in the financials. Okay, so let's put it all together, side by side. It's a tale of two promises, really. On the left, equity settled. It's a fixed cost, locked in, totally predictable. It sits nicely in the equity part of the balance sheet. But on the right, you've got cash settled, a floating liability that's constantly changing and can make your earnings bounce all over the place. Two very, very different stories to tell investors. All this talk about fair value leads to a pretty obvious question, right? How in the world do you actually calculate it? How do you put a precise price tag on a promise that's tied to the future? Well, thankfully, it's not just pulling a number out of a hat. IFRS 2 is super clear that companies have to use established, sophisticated financial models. You'll hear names thrown around like Black-Scholes or the binomial model. Just think of them as these powerful calculators that take a whole bunch of information and crunch it to come up with the best possible estimate for that promise's value. And these models, they're hungry. They need a ton of data, a bunch of key ingredients to get the recipe right. Of course, you need the basics, like the share price and the exercise price, but then it gets tricky. You have to make educated guesses about the future, like how volatile the stock will be, or how long people will hold their options. It even pulls in big picture economic stuff, like interest rates and dividends. It's a complex puzzle. So, we've gone through the how, but what about the so what? Why does all this accounting wizardry actually matter? Well, it's all about telling the true financial story of a company. You got to remember, before rules like IFRS 2, the cost of all these stock options was often, well, kind of invisible. It was a hidden cost that didn't always show up on the income statement. The whole point of this standard is to drag that cost into the daylight so that anyone, investors, analysts, you name it, can see the real economic price of paying people with equity.
And to make sure that transparency actually happens, companies have to share a ton of detail. This table gives you a good idea of what they need to spell out. They have to describe the different awards they have, show how many were given out or exercised, and this is crucial, explain exactly how they calculated that fair value, including all those assumptions. And finally, they have to show the bottom line impact on their financials. No hiding allowed.
And really, this quote from the source material just nails it. The number one goal is reflection. It's about making sure the financial statements are a true mirror of what the company is doing, and that includes the promises it's making to its team. It forces everyone to admit that giving away a piece of the company is a very real cost, just like a cash salary. So the next time you're digging into a company's annual report, especially a high-growth tech company, just ask yourself this question. Thanks to IFRS 2, now you know exactly where to look to find the answer. It challenges us to see if the financial story being told is the whole story, right down to the price of every single promise.